Hi everyone, this is Nikita, and in this webinar, we are going to be talking about inventory valuation. We're also going to be talking about valuation of inventory using Zoho Inventory and Zoho Books. What is inventory valuation? Why do you need to do inventory valuation? What are the different methods or ways to do it? And which are the methods or ways that are applied by Zoho? We'll be talking about all of this in this webinar. The first question that comes is, what is inventory valuation? Now, at the year end, when you're closing your accounting period, you need to assign a value to that quantity of stock which is lying in your go down. You need to do this so that you can compute the profitability of your organization. Inventory valuation is done to find out the value of the unsold inventory while preparing the financial statements. So, for example, if you are someone who sells footwear, you have a stock of 1,000 footwears lying in your godown as on 31st of March 2022. You need to be able to assign a value to all those footwear to decide what is your closing inventory value as on 31st of March 2022. This value will also help determine the profitability of your organization. So the software that you use, the accounting software, should be able to assign value to your closing inventory. You should be aware as to what are the different methods that are available out there and what is the method that your accounting software is following. Why do you need to do inventory valuation? Now, whatever is the value of your inventory, it impacts the working capital of your organization. Loans are dispersed by banks for the working capital needs of an organization. Working capital represents the current assets minus the current liabilities of an organization. Now, closing stock forms a part of these current assets. So, the value of your closing stock will also help determine your working capital needs. As I already mentioned, inventory valuation has a direct impact on the gross profit of your organization. So, whatever is the value of your inventory will have a direct impact on the profitability of your organization. Inventory valuation also needs to be done to have a fair representation of a company's finances. So, for all these reasons, it is necessary to value your inventory. Yes, the value is pretty straightforward. It will be quantity into the per unit cost that should give you your inventory valuation. However, practically, there are a lot of issues associated with it. You would have bought the same goods at different rates at different time in the year. So, how do you value this inventory? Before we go to that question, let's see how to calculate gross profit and cost of goods sold. I keep saying that the value of your inventory affects the profitability of your organization. So let's see how is gross profit calculated. Gross profit is nothing but sales minus cost of goods sold. What is more important here to know is how do you calculate cost of goods sold? Cost of goods sold is nothing but the opening stock, add whatever you've purchased during the year, minus the closing stock at the end of an accounting period. So, this actually means that whatever was lying in my stock, I need to add to that whatever I'm adding during the year, and I need to deduct whatever is remaining in my go down as at the year end. This gives me the cost of goods sold, the cost of the goods for which the sale has actually happened. Now, this cost of goods sold is then used to calculate the gross profit of an organization. There are different ways of calculating this cost of goods sold and calculating the value of the closing stock. Let's look at an example first. We're going to learn three methods of inventory valuation. We're going to use the same example for all the three methods. So pay attention at the example. In this example, we're calculating the closing inventory for the month of April 2022. Now let's assume that in this example, we are engaged in sale of mobile phones, retail sale of mobile phones. So we are buying from the distributor and we are selling it in our retail store. We need to calculate the closing inventory for the month of April 2022. Now, the opening stock is 15 units the rate of which is 9,000 per unit. Some purchases were made in April 2022, 50 units. The cost at which they were purchased is 10,000. Total cost 5 lakhs. Now the total goods available for sale is 50 plus 15, which is 65. We need to calculate the cost of goods sold for the actual sale quantity of 60 units and the value of the closing inventory of 5 units. Now, this is a common example. We are going to use it thrice in all the 3 methods that we'll be discussing. We use these methods for calculating the value of cost of goods sold and for calculating the value of closing inventory. Let's talk about the first method. First in, first out. As the name suggests, this method, it assumes that whatever items you've purchased first, you're going to sell that first. So whatever you've bought first will leave the warehouse first. And whatever remains, that is the remaining stock items, they will be valued at the most recent purchase price. So let's take an example, the same example, to see how FIFO is used. Now, in our example, opening stock is 15 units at 9,000, 1,35,000. Purchases 50 units at 10,000, 5 lakh rupees. So the goods available for sale are 65 units. Out of the 65 units, 60 units have been sold. Now in this case, we're using FIFO, first in, first out. So out of the 60 that was sold, 15 was sold from the opening stock and the remaining 45 was sold from the purchases in April 2022. So for the first 15, we'll use the value of the opening stock, and for the remaining 45, we'll use the value of the purchases made in April 2022. This gives you a total value of 5,85,000. And your closing inventory, which is 5 units only, will be valued at your most recent purchase. Your most recent purchase was at rupees 10,000. So 5 into 10,000, the value becomes 50,000 rupees. Again, how did I get the value for the closing inventory? Of course, if I've used the 15 out of the opening, I've used the 45 out of the purchases, the remaining 5 of the purchases are still lying in my stock. This is the assumption that FIFO makes. First in, first out. So whatever remains will always be valued at the most recent purchase price. In this case, 10,000 rupees. So the gross profit in this case would be 60 units were sold at 15,000 rupees. 9 lakh rupees was the total sales. Cost of goods sold. Again, we have calculated COGS here, 5,85,000 using FIFO, first in, first out. So your gross profit will be 9 lakh minus 5,85,000, which is 3,15,000. This is the first method, FIFO. Zoho Books and Zoho Inventory both use FIFO for calculating the value of the inventory, which is uploaded on Zoho. Now, currently they're using FIFO. They're going to add one method, which we'll be discussing shortly. The next method is last in, first out. Now, this method assumes that whatever items you've last purchased will leave the warehouse first. So, whatever were your recent purchases, they will be sold first, and that is why we'll use their value first. The remaining stock items of the inventory, they will be valued at the old purchase rates. Let's look at the example again. In the same example of opening stock of 15 quantity at 9,000 and purchases of 50 quantity of mobile phones at 10,000, cost of goods sold for last in, first out, which is LIFO, will be, first you'll use the most recent purchase. So 50 units were bought at 10,000 rupees per unit, and the remaining 10 units will be used out of the opening stock at rupees 9,000 per unit. So in this manner, the quantity of 60 will be divided into 50 from the most recent purchases and 10 from my opening stock, giving me the value or COGS of 5,90,000. My closing inventory of 5 units will be valued at the opening stock value of 9,000 rupees. So here the closing inventory value is 45,000. The gross profit, sales minus cost of goods sold, sales remaining the same at 9 lakh rupees. Cost of goods sold in this case is 5 lakh 90. We've calculated it here. Gross profit 3 lakh 10. Now if you notice in our earlier example, the gross profit was 3 lakh 15. Why? Because we were valuing our closing inventory. We were valuing our closing inventory on the most recent purchases. Our value of closing inventory was higher. And that is why the value of the cost of goods sold was lower. Whereas in this example, the value of the closing inventory is lower and the value of the cost of goods sold is higher. This is happening because of the assumption that these two methods make. In FIFO, we're making an assumption that whatever came first will go out first, which is a lot more logical. And that is why a lot of people use FIFO. However, in some cases, people might also go for LIFO. So in case of LIFO, whatever has come last will go out first is the assumption that is being made. But the most important point here being that in both the scenarios, your closing inventory has changed, your COGS has changed, and the gross profit has also changed. The last method that we're discussing today is weighted average cost method. Now this method says that, okay, let's calculate the weighted average cost. And let's use that weighted average cost to calculate my cost of goods sold and to calculate my closing inventory. So the weighted average method is used to determine the amount that goes into the cost of goods sold and my closing inventory. Weighted average cost is nothing but the total of cost of goods sold in the inventory upon the total units in inventory. Let's look at the example again. Now in the same example, where the opening stock is 15, purchases 50 units, goods available for sale 65 units. Now, focus on this cost. Cost of opening stock 1 lakh 35. Purchases of 5 lakh were made. Total 6 lakh 35,000. Now, as per the weighted average cost method, you will take the actual cost divided by the actual quantity. So in this case, you will take 6 lakh 35,000 divided by 65 units. You get 9,769.23. Multiply it by the units that are sold. That will give you cost of goods sold of 5,86,154. Closing inventory will also be valued at the weighted average cost, which is 9,769.23. 5 units calculated at 9,769.23 gives you 48,846 rounded off. Now the gross profit will be sales of 9 lakh minus the cost of goods sold of 5 lakh 86,000. So a gross profit of 3 lakh 13,846. Now in this example, if you notice, the gross profit is highest in the FIFO method. This is because we are assuming that whatever is coming first is going out first, and whatever purchases I've made later, which are at a higher cost, my inventory is being valued at that cost. That is why my gross profit has gone up. Right? So different methods will lead to different gross profits, and that is why it is necessary to determine a method and stick to it. Zoho is very soon going to come up with weighted average cost method in their software. Currently, they're using FIFO. So whatever is coming first is going out first is the assumption that is being made. Very soon, they're also going to come up with a weighted average cost method. Now, what are the methods that are actually prescribed? If you check the Accounting Standard 2 and the ICTS 2, which is used for taxation purposes, you have to value your inventory at cost or net realizable value, whichever is lower. Sometimes it so happens that you have a lot of inventory which is obsolete or which is slow moving, non-moving, for which you also need to determine the net realizable value of your inventory. Now, if the net realizable value has actually gone below the cost of your inventory, in that case, you're required to value it at cost or net realizable value, whichever is lower. You need to provide for the decrease in value of your stock in case of obsolete, non-moving, slow-moving inventory. The two methods that are prescribed and are used commonly are FIFO and weighted average cost method. And like I already mentioned, Zoho Inventory and Zoho Books, they use the FIFO method currently for valuing the inventory. Very soon, they're going to come up with the weighted average cost method as well. Now, if you go to Zoho Inventory, Zoho Books, you can download your inventory valuation, summary inventory valuation reports to get these details. You can also get a quantity report if you wish. But inventory valuation is extremely essential as on the closing date when you're closing your books of accounts as on 31st of March. So it's necessary for you to know that your accounting software, Zoho Books and Zoho Inventory, are both currently using FIFO, and that is how your inventory is being valued. This has a direct impact on your gross profits. So even when you're changing the method of your inventory, if you're changing the valuation method of your inventory, it requires a separate disclosure in the financial statements.